been talking, Joe, about the economy and how it is resilient, right? And that's why the Fed should actually start to move in terms of normalization. And I just was very comforted by the fact that Jamie Dimon was talking about a lot of positive things about the economy, namely the consumer, which you know is 2/3 of the economy. So we're all watching the consumer. And I have said that they are in good shape in terms of savings and in terms of jobs and wages and that sort of thing. But he basically just listed a whole host of things that were really positive, like balance sheets are in good shape, debt services, the ratio is at the best levels in 50 years, that consumer spending 25% more than pre-COVID levels, that they have $2 trillion in the checking account, so there's pent-up demand. So there's lots of things he talked about. And then he also did say that businesses are also doing quite well. And we know that free cash flow generation has been the theme for the last year and a half at corporations. And they're doing good things with that free cash flow. Not only buybacks and dividends, but they're also putting it into CapEx. And that's very important for the business cycle. So I think all of these things are good. It's not perfect. We know Omicron is certainly an issue. We have to get through it. But I think once we get through it, we will see a snapback in the economy. And that's a good thing. And the Fed can do their thing in terms of normalizing policy, which I thought, by the way, he did a very good job yesterday, walking that tight line there.
Yeah, well, Omicron, it's like we got to get through it collectively, and I think a lot of people just need to get through it individually. It is everywhere. It's everywhere, and every day I see it. So it's weird the way you said that. We need to get through it. And it's like, yeah, as a society we need to, and there's a lot of individuals. Hopefully everyone does too. It definitely is a much more serious thing for anyone with comorbidities or the like. But hopefully for most people it's something that it's a week or so, you're done, and move on. Hey, Sarat, just reading your notes, you know, you're always sort of a sober guy. I just talking about in terms of investment advice. I didn't think that you sounded that optimistic in some of your notes. You're like, yeah, buy the dips, but make sure it's quality in terms of tech. And, you know, value's probably going to do a little bit better than growth because everybody's got in rising interest rate environment, you have to sort of justify your valuation. So you're not like jumping up and down right now, are you, about buying?
No, what I'm saying, Joe, and you're right. I mean, if you read through kind of the underlying there, I think this chasing of mega caps for the last 10 years is going to start stopping. And really what I mean by that is I think, you know, Stephanie hit the nail on the head there. The consumer is really strong. We have to look at where the puck's going to go, and money's going to be spent on services. Money's going to be spent on other areas once we get through this. And I think that's where the opportunity is going to be. And it's going to be companies that really haven't had, you know, their day in the sun. So you're talking about companies like financials. I mean, a strong consumer, company like American Express that's going to benefit from that. Rising prices, you want to make sure that you're in areas where margins are going to increase, and the E of all of these earnings, you don't want to be buying companies at their peak. So I'm still pretty sanguine on the market. I think you just have to look at other areas. The market will do well through this. And we know, you know, with comments like Jamie Dimon that the economy is strong, we can have rates go through it. You just have to be prepared that multiples can come down. And when we haven't seen that, the recency bias of especially the last couple of years, where, hey, just because something's trading at 40 times sales or 25 times earnings, it's going to stay that way. That's not going to be the case for the next 3 to 5 years. I think you're going to get back to, you know, the reversion to the mean. That's going to be kind of the common phrase, I think, going forward. But there's going to be plenty of opportunities. I think financials are really strong, 14 times earnings on average. The E is going to expand. Energy is strong. Industrials, you know, there are areas of the market that are definitely going to be doing well, but you just have to be careful not to chase the past, because there's going to be other opportunities, and capital will flow there. Capital will go where the opportunity is going to be.
So, Steph, we've had conversations in the past about, you know, whether you keep riding some of the reopening trades. Is there anything left? Are we already reopened, or is there still some value there because of Omicron? Is there a reopening trade left for you, and would you take it?
I definitely think there's still opportunity in reopen. They kind of have fits and starts, Joe, right? They kind of get excited, like in the fourth quarter when we got through Delta. In the third quarter, you had a nice surge in reopen. And then we have Omicron, and now these stocks have paused. And so I do think that's one area of opportunity. And I own a host of them, you know, between Vail Resorts, between Hilton, Expedia, Match Group, even something like a Boeing, by the way, is also sort of reopen, right? And then you have like a GE, which is the derivative of that because they build the engines for Boeing and Airbus. So there's plenty of ideas out there. You know, I am leaning more towards cyclical, more towards reopen versus tech versus growth. I'm 10 percentage points underweight tech. Which, by the way, is still a huge percentage point in terms of what I own, because if you add up tech and comm service, it's 38% of the S&P 500. So I'm 28% exposed, but I am more focused on what Sarat just said, financials. They've had a nice run to start the year, but I think there's more to go. He mentioned 14 times earnings. I mean, I'm looking at book values. Wells Fargo, 1.2 times book. Citigroup at 0.7 book. The only one that's really expensive is JP Morgan for obvious reasons because he's a hero. But at 1.9 times, that's not the area where I'm in financials, but I do think there's plenty of upside. Let's get through inflation this week. Let's get to earnings on Friday. I think there's lots to be learned, but I still think that you want to tilt more towards cyclical and value to start the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.